First up, we will be joined by Mr. Mukesh P. Kalra, who's the founder and CEO of ET Money, India's largest app for financial services. He comes with over 13 years of experience in building businesses and products from the scratch in the consumer, internet, and mobile advertising space. So if I may please, I believe they will be joining us in a short while. Let me also go ahead and introduce our next set of speakers. We will be having the presence of Pratik Oswal, Head Passive Funds, Motilal Oswal Mutual Fund, and under his leadership, Motilal Oswal AMC launched India's first and very popular S&P 500 index fund, and he's also instrumental in creating awareness about international investing through passive products. Joining us next, we also have with us none other than Radhika Gupta, who's the Managing Director and CEO, Edelweiss Mutual Fund. In fact, as we talk about Edelweiss Mutual Fund, one of India's fastest growing mutual fund companies, and she's also been recently elected as the Vice Chairperson at AMFI, and she's also an avid motivational speaker, and also renowned for her recently authored book, Limitless. So congratulations on that. I think so many of us have had the pleasure of interacting with her virtually, including me. So it's wonderful to see you here in person, ma'am. Our next speaker, ladies and gentlemen, we also have with us Shiv Gupta, who's the founder and CEO of Sanctum Wealth. And over a prolific experience of across 25 years, he's held several leadership positions in wealth management across Asia as well as Middle East. And immediately prior to founding Sanctum Wealth, he was also head of India and co-head of the Middle East for the Royal Bank of Scotland's private banking division. Now, there's one person who will be extracting all the insights from the fellow panelists. We have with us none other than Umang Papneja, who's the ED and CIO, IIFL Wealth, and he comes with more than 18 years of experience in investments and wealth management. So it's time for Umang to also set the tone, and it's time for us to welcome our speakers. But firstly, can we have an active round of applause, ladies and gentlemen? Let's welcome our speakers on the stage. Over to you.
Hi, Mukesh. Please come. So good morning, everyone. And it's a pleasure to be here always. And thanks, Prem, for inviting me. I also was looking at the agenda. I'm the only moderator of the sessions today where Prem is not moderating. So Prem, thanks. Thanks for. So thanks for that honor, Prem. So we've got an action-packed panel. So we've got from the client side, we have Shiv and Mukesh. Shiv, of course, we had the round of introductions. So Shiv heads Sanctum and Mukesh heads ET Money. And from the manufacturing side, if I can call it the manufacturing side, Radhika, of course, from Edelweiss, and Pratik from Motilal Oswal. But Pratik also obviously brings in a lot of other experiences and learnings from the group. Also, not many people know that Radhika has been doing some pioneering work on passives while she's been at Amphi. So she's right now the vice chairperson, but of course before that as well, she was heading the committee for passives, if I remember correctly. So Radhika, maybe we can start with you. Just set the tone. What are the instruments available in passive? So, people talk about only passives as ETFs, and not many people talk about fixed income passive. So there are many things which are available. Maybe for the audience, you just want to cover that.
So thanks, Umang. Thanks, everyone. I must say, Prem and team, this is the first real conference, and I am not going to too many of these. This is the first real conference I'm doing in person after 3 years. So it's just very nice to see everyone and not see a count of participants. So it's really, really nice to be here. So coming to your question, I think Umang, 3 years ago, if you had discussion like this on passives, I think the definition of passives would have just been equity passives, and that too within equity passives, it would have been a very limited set of products in the market. I think largely what I would call market cap based passives. Today, that landscape has changed, and I think the narrative is also gradually changing. So if you see what is out there broadly, and we are doing a lot of work at AMFI in terms of new passive regulations, which I also hope to see soon. But you, I think, have three meaningful or four categories now of passive funds. You have the whole equity passive space, which has widened from your traditional market cap based passives to also include a lot of thematic passives, a lot of sectoral and thematic passives, Indo-global themes. For instance, we have an Indo-global healthcare fund. You have a bunch of smart beta passives, whether it's quality, momentum, etc. And some of them have actually gotten traction. You've got this now very large category of fixed income passive products, which are essentially what started with Bharat Bond back in 2019, but now account for about 80,000 crores of AUM, and happy to talk about the growth of that further, but largely target maturity funds. That give investors an FD-like or, predictable return experience with the tax benefits and all the good things of the MF platform. So that's 80,000 crores. And I still believe while we've done a lot of work on target maturity, we've not even scratched the surface on other ideas when it comes to fixed income passives. So we'll be filing a lot of non-target maturity ideas shortly. You've got commodity passives. You already had gold. You've got silver, and the regulator is also very favorably, hopefully, looking at more products in the commodity space. And then finally, you've got a nice range of international passives. And I know Pratik and his team, and then a lot of others have done a lot of work on international passives. So the good thing now is with passive products, you can actually do a complete asset allocation for a consumer. That's what's replicable today.
Absolutely. And of course, the topic of today is how do we build an advisory business on passive. So we'll come to that. Just talking about statistics. So Radhika was talking about AUMs. If I remember correctly, I think we were some 1 lakh crores 3 years back. Now we are some 6 lakh crores. So that's 5 lakh crores in 3 years, which we've added. Now just to compare that with actives and only looking at the equity parts, I think it's gone from 8 lakhs to almost 14 lakhs now. So which means that if you just strip off the MTM effect, because obviously markets have done around more than 50% since then, more money has come in passives than actives. Now, coming to just take a sense of the client side. So, questions to both Shiv and Mukesh. How are you seeing client preferences towards passives in your client portfolios?
Okay, thank you. By the way, Prem and Cafe Mutual team, thank you very much for having me here. I also echo Radhika's thoughts around meeting people in person. It really is wonderful, so thank you. I just want to give it a slightly different angle. I know we're talking about a lot of passive products, which are basically packaged instruments, but passive is really an approach. So if I take a step back and look at it from the point of view of what is a passive approach, it is buy and hold, low cost, minimize buy and sell decisions, etc. Then ETFs, index funds, and some of these things are not the only ways to reflect interest in passive investing or the way our clients invest passively. So why I'm saying that is that whilst we've seen quite a lot of growth in interest and AUMs of our clients in passive investing, there are many clients who invest not through these products, but through direct indexing, through custom indexing, through constructing their own portfolios and just holding them. And Umang, you may have seen this in your own business. And so if we look at the total AUM of these types of products, they may have grown from 4-5% of our AUMs to maybe 15% of AUMs. But if I looked at how many of, what is the entire passive investing AUM that we have, then the number may be somewhat larger than that. So that's an angle that I just wanted to add on this. Radhika has already commented on the growth of the different types of strategies, and perhaps later in the conversation we can talk about in what context we use those strategies. But for now, I'll just leave it with that thought.
Thanks, Shiv. So, Mukesh, any thoughts what you're seeing on ET Money?
Yeah, first of all, thanks Cafe Mutual team for inviting me. It's I think the first conference for a lot of people to be in person. Great to see the audience fully packed. So the way we are, at ET Money super kicked about the whole passive movement that is happening. In fact, the way to look at passives, we bucket it into largely three ways that it can be actually looked at from a retail consumer perspective. One is your indices, which is the Nifty index and all that. I think that constitutes a large proportion of what is happening on the platforms as well. If it is passive investing that is happening, then a large part of it is index based. But what we are more excited about is now rule based investing, which is quant models, are actually becoming far more evolved. There are possibilities of actually combining all these combinations, and as Radhika was saying, to all these innovations that are happening on the manufacturing side, how do we actually bring it to the end consumers in a advisory model is what I think the future is going to be eventually. Because given the volatility in the market, I'm sure that this is the time to shine as an advisor, right? To actually kind of hold the consumers when the volatilities are high. But how do you do that? You do that by actually combining asset allocation strategies with underlying, passive funds. And I think that we are seeing a very strong pickup of that, pretty much kicked about the whole innovation theme that is happening in the space. And as you said, 6x growth on passives is exciting for us. And we are seeing a very strong uptake of that on the platforms.
So if, say for example, 100 transactions are happening on ET Money, for instance, how much of that goes into passives?
It would be in the range of now 10 to 12% easily.
Right. So quite similar, both HNIs as well as retail, I think, are around 10 to 15% right now. Now, Mukesh spoke about business models, advisory business models. I think personally, when there were two large regulatory changes, one happened some years back and one very recently. One was the introduction of direct plans, and second was the advisory regulation. So I think both of them put together become a very, very strong force to kind of kickstart the advisory business. So I just want to, probably talk about on the panel, what sort of advisory business models are we seeing before we go into whether, how to build a profitable one, which is the topic of today's session. But what kind of business models are we seeing? Maybe if both, maybe Pratik, you want to just take that, and then Radhika, if you want to just add on to this.
Yeah, so firstly, again, thank you for Cafe Mutual for having us and for this event. I think in terms of business models, I just to give a background, I actually used to be a wealth manager. So I used to manage money for clients. I had about 700, 800 customers. This was about 4 years ago, and what I saw was that about 50% of their assets under management or their wealth was invested in passive funds. So there was about a rough 50-50 split between active and passive. And when I came back to India about 4 years ago, I saw that I think there was close to zero allocation to passive funds. There weren't very options. There were a few ETFs here and there with almost no liquidity. And also I think there was no allocation to internationals. No one was talking about as Mukesh said, quant funds. So I think there were a lot of gaps in the market, and I think passive is one such vehicle which really plugs those gaps in a very simple way. I think most people tend to see passive as a Nifty or a Sensex, but obviously there's a whole world beyond that. And I think you'll see a lot more innovation in this space going forward over the next 4 to 5 years' time. I think in terms of business models, I think what's really funny is, I think when you compared, say, India to the US, is that, for some reason, here a lot of clients see fee as a fine, as opposed to like a fee. When you're going to an amusement park, you don't see the the admission fee as a fine. It's a fee you pay to enjoy the rides. For some reason, here, like a lot of people see it as a fine, and I think even the way sort of you sell mutual funds or at least direct plans is, it's a fee and it's a fine and all of that. So I think it needs to be, so that's a level of maturity is something which I think will probably happen over the next 3 to 5 years time. I feel that fee is going to be a lot more prevalent, and I think also in the US, where in the late sort of 70s and 80s, it was primarily a sort of distribution type of industry where I think a lot of, whereas now I think it's mostly advisory, and obviously, and also what's surprising is it's mostly driven by independent financial advisors. So I think about 60-70% of all the wealth is actually driven by independent financial advisors, which I think is probably what's going to happen here over the next, say, 5 to 10 years time. So I think it's very sort of exciting, for a lot of MFDs or RIs out there, because I think if you see the shift, I think it's going to be in that favor, and with that you'll see a lot more demand coming in. I think for this industry. So ideally, I think in terms of revenue models, at least what I have seen so far is it's highly customized. If so far it's been quite customized, where you would obviously go to a client and there would be some form of negotiation about what the fee is, and it might have certain barriers or whatever it is. I think that's what at least I have seen. But also I think a big part about fee is also to do with subscription. If you look at India as a country, most retail investors tend to be quite small. Unlike the US, where like an investor can go beyond 100,000, 200,000, even $500,000. Here, I think the average investor would do about 20,000, 30,000 rupee SIP. So in that sense, it makes more sense for us, to sort of focus more on user acquisition and on the sort of subscription base, at least on the sort of lower end side. Whereas on the higher end side, I feel like so far it's been quite custom, especially for multi-offices, multi-family offices, and all of that. So I think that's at least where I have seen in terms of how sort of business models have evolved, at least so far in the industry.
Thanks, Pratik. Radhika, you would have seen advisors in close quarters, right? And most of these advisors would have been distributors before. So how are you seeing that transition happening in the section of the distributors who become advisors?
So I'll tell you, there is a lot more openness, and I'll give you the example of what we see in terms of the distribution profile of a product like Bharat Bond or debt passives, which has become really large scale. We now have distributors, we now see a product like Bharat Bond or our debt passives being used by managers on small case, and guys like Mukesh as part of their asset allocation solutions on ET Money. So that is one. We see it being used by RIAs, pure play advisors in their asset allocation portfolios. And we also see it being used by traditional wealth management guys. So I think there are 3 models out there who are, using passive funds in some way, and all 3 have their own merit. I think in the case of guys like Mukesh, using passive funds is really a building block, and then layering your own automated asset allocation or personalized asset allocation or whatever you may call it is a great way, because then passive funds really become like Lego. You make, you use them and you build whatever ship that you want to build. I think we have engaged very closely with the RIA community over the last couple of years, the pure fee-based advisors. For them, I think the attraction is the low-cost nature of the passive product and their ability to then build a solution and charge on top of that, again, the Lego thing. And I think what is also nice is that traditional distribution is adopting passive, which is why often on panels when I'm asked about things like active versus passive, I think it is a very silly discussion, because it can easily be active and passive. I think, as Shiv rightly said, passive is an approach, it's a solution. And there can be, a wealth guy suggesting AIFs and PMS as a client solution on one side, and a fixed income passive and an international passive on one side to create a client solution. So it's not ETF versus index fund versus this. It's about using this as a solution, and we're seeing all 3 guys use it.
Perfect. So just to probably summarize what the panel is saying, so that essentially 3 prevailing business models. One is, of course, the online robo-advisory. Second is multifamily offices. And third, I think, and also I'll put RIs in the same bucket. And third, of course, traditional old wealth managers also trying to do some bit of advice. So maybe on the last, on the wealth managers, Shiv, any thoughts you're seeing from a client preference wanting to go advisory versus distribution?
If you don't mind, I'm going to borrow a leaf from what Radhika just said and widen this question slightly.
Yeah, sure.
I'm still trying to answer the question. This passive debate that's been taking place, and we follow this domestically, internationally. The reality is, and it seems like the settled view amongst most practitioners, that people exist on a spectrum of activity, right? From the very transactional to like completely just leave it type of an investor, and most people are somewhere in the middle. And they use passive instruments, passive approaches as building blocks of portfolios. So when we think of that, we just need to understand this broader nuance. It's not all neatly packaged into one or two buckets. And that's why it's sometimes difficult to kind of answer things that point to what might appear like one of those buckets. So that's just one point I'll make. Coming to your question, more specifically, Umang, as wealth managers, and maybe you could answer this question just as well, our use of passives and our clients' use of passives is guided by two principles. One, what are they thinking? And two, what are we thinking? Of course, what they are thinking is hopefully influenced by what we're thinking. But our thinking is based on our investment philosophy in the first instance. What are the core tenets of our investment philosophy and how does that relate to passives? So we believe in asset allocation as the primary driver of good investment outcomes to begin with. So that means you need to have a very clear strategic asset allocation. We believe in the value of tactical asset allocation in creating good investment outcomes. Call it alpha if you want to, but we believe in that. We believe that there is room for value addition through manager selection. We believe there's room for value addition through security selection. Now, where that room exists will depend on your view on where alpha is or not based on market information, asymmetry and efficiency and wherever you sit on that debate. But based on these principles, we then construct the portfolios that we would recommend to our clients. So for example, we have, let's say, a balanced portfolio. That's a good reference anchor to talk about investing in general. A balanced portfolio would have 20 to 30% in passives, right? Just because we think that, for that particular sub-asset class exposure, that's the best instrument. Quite aside from this, if we think tactical asset allocation is very important, then tactical asset allocation transaction efficiency is also very important. So if you create a whole bunch of active funds that represent your equity allocation, then making changes to that is a little more efficient in most markets if it was represented through passives. So it's thinking like this that reflects how we use passives for our clients. And like I said earlier, we've seen interest in passives grow. Part of it is because we are driving it through where we think clients should invest through passives. By the way, a lot of it is tactical. Like Radhika was talking about all these different asset class, thematic, asset class, commodity exposure that you have that allows you to take tactical views too. So that's another thing that is influencing client interest. So that's how we think about it. And client interest, as I said, has been growing. The size of allocations has been growing, and it looks set to continue on that path.
Perfect. I just want to probably just change the course of the discussion. I just want to make a statement to the audience and a sort of a question, and then maybe if somebody wants to answer, we can. So I just want to make a statement here that when you invest in an equity ETF, you are actually getting paid to invest in an ETF. How many of you actually agree with this statement? I'll just repeat the question again. If you invest in an equity index ETF, you are actually getting paid to invest in that ETF. Anybody agrees with this statement? So we need a lot of education to be done. I'll just answer that for you. Now, so when you buy the index stocks, the dividend yield is around 1.8 to 2% of all the stocks which you do. A mutual fund saves 35% of your dividend tax, because irrespective of your tax bracket, 35% you have to pay as dividend tax, so that's 70 basis points. All index funds are lesser than 70 basis points for sure. So you're actually getting paid to invest in an ETF. So now this brings me to a discussion which I want to just set up for the panel. How important is manufacturing if you're building an advisory practice? So we're seeing Zerodhas, etc., getting into this. So would this be the motivation?
Umang, you're looking at me, so I assume I have to answer this. Okay. How important is manufacturing? Look, I think in general, in the advisory and wealth management business, we are seeing a trend, and some of my colleagues are probably better suited to answer, to backward integrate into manufacturing. I would say, and there are reasons to do it, and then there are, of course, some guys who are pure play manufacturers, right, like us. There's no harm in getting into manufacturing. I would only say that passive manufacturing, and I was talking to some of my friends in the media yesterday, passive manufacturing is also a specialized business. Sometimes there is a tendency to say, अच्छा passive fund है, इसमें तो कुछ नहीं है, तो unmanaged सा है, तो हो जाएगा. I know in our setup, to run the fixed income passive business under the guidelines that the regulator has, with the constraints of the debt market, it's actually far easier to run an active business. My fund managers complain. So I think manufacturing of passives is a specialized business, whether it is equity or fixed income. And by all means, anyone is welcome to get into it, as long as you do a good job with manufacturing. I'll also make an unrelated point, Umang, which I guess was the, title of the panel, is that the passive business is a hard business to run profitably. It is hard to run profitably as a manufacturer, very hard, because you really make very little money. Yeah. And I'm sure it's not easy to run if you were running a pure play business as an advisor. So the economics of it start to make sense when you have a certain amount of scale. I've seen this, I think 3 years ago, when we started the fixed income passive business, the most common question we got from both shareholders and the external world was, but ye profitable kaise hoga? How will this animal become profitable? Because literally the expense ratios there are 3, 4, 5, 2 paisa. I can tell you it is profitable now, but at a certain size. So passive business, if you're manufacturing, needs a certain scale to be profitable, to be efficient, to do sourcing well, to run it well.
Perfect. Now, so of course, you spoke about passive manufacturing, how scale is important. Maybe flip the question to Mukesh, and also maybe Pratik, you can add to that. How do we reach profitability running an advisory business? What's the path?
Yeah, I think everybody wants to kind of figure that out for sure, given that the audience is collected for that. So I think the way we have been looking at it is to look at, there are segment of consumers, then there are product arrays that the manufacturers have actually created, and then there is pricing, right? So it's like a typical, traditional way of looking at simple product segment and pricing. Now, at an overall level, we believe that, just to throw some facts, there are 50 million investors overall, give and take, in the country today. Slated to go to 100 million. I'm hoping that it happens faster than ever. Only 1.5 lakh investors in the country today have access to or has availed any kind of wealth management services. So what has happened is, in the past 5 years, we've done an amazing job in creating access to wealth transactions, right? We have removed the pains from, you can start in like no time. You can select the product faster. You can actually, all that wave of innovation is leading to a market expansion, right? But if it is only 1.5 lakhs out of 50 million actually kind of availing any kind of wealth management services, the gap is huge. And 2 years into the investing journey as a retail consumer is when you start to feel the need of actually having an advisory or any kind of help needed, right? And it is Also because of the ecosystem is driven like that. Like everybody is driving you to do more and more transactions, keep on buying more funds as well. After 3 years, you see that you have like 10 stocks, 13 funds, and then people have dabbled into crypto. People are buying covered bonds, which are like super risky. I don't know how it is happening, but people are buying left, right, center, everything that is being thrown right at them. And what that does, it creates a unique problem for the consumer. Every decision then subsequently becomes extremely tough. If you have such a large portfolio and at very small amounts, right? Now you have a 1 lakh portfolio and you have 6 different kind of products into it. Everything is super complex. Simply because you've not taken enough position bets, you're not actually kind of managed from the position point of view. How much to invest more, where to invest, if you want to redeem, where do you redeem from? So everything from a retail journey point of view becomes complex. And if I combine these 2 big points, that 50 million users, only 1.5 lakh availing services, at least 20 to 30 million of them need some form of advice now. And simply because their portfolios would have actually become 2 to 3 years. And the pain points that I'm talking about, it's like a huge, huge opportunity waiting to get unlocked, right? And then on that, you have to superimpose the whole segment to product to, pricing. So the way we looked at it was, we want to focus on a segment which is 10 lakh plus to upwards of 1 crore in income. That's where the biggest pain points are. The, IIFLs of the world, you guys are super specialist in the HNI category. So I think that segment needs a very different kind of approach. The next segment needs a very different kind of approach. And it has to be tech first. Only then you can create that kind of impact. You can actually reach at that price point that you want. So we, on ET Money Genius, which is our advisory service, we actually spent like 3 months figuring out what should be the price. Because the moment you make price as a % of AUM for a retail consumer, it becomes huge. Even if it is, $500 a month.
Right.
So we priced it at 249 and kept it flat because we thought, we believe that if at that price point and the product construct that we have, we can cater to the segment far in a profitable manner.
So this is 249 per month?
249 a month, yes. And then it actually kind of, the third thing that it did was, if you are actually getting into an advisory business and coming to that point of whether you should go into manufacturing and all that, right? We actually get asked similar questions, why are you not opening? Everybody is actually going for a AMC, why are you guys not thinking about it? So I think it's to do with where do you want to build your core competencies. I would let Radhika and Pratik innovate like hell on the manufacturing side. They're specialists there. I will innovate and figure out the best way to reach the consumers, solve their problems at scale, right? And I think there is this whole thing of, and from an advisor perspective, the entry barriers are not very small in AMCs. I think people actually underestimate. I'm sure Radhika would, and Pratik would also kind of second that. Passive, massively scaled business. Even if you have like 1 lakh crore of AUM, which is like, people have taken insane amount of time to reach there, and you're making like 0.2, 0.3, % there. It's an extremely, extremely tough, economics to, first, how do you get to that 1 lakh crore, right? So I think it's more profitable to be in the advisory zone than going into manufacturing and muddling your core competencies. So I think for us, and that's our view, people have their own ways. The only reason that people would get into manufacturing is when you have achieved so much scale on the advisory side that you now want to actually have more margin capture, because that's the only reason that you would end up having. And you could see that you can actually get to a 1 lakh crore AUM because you have a base. That's the only time that you would start to think. But as I said, the market is just opening up. Thinking about manufacturing and then actually taking it to the consumers, it's a very
That's a very interesting numbers which you've thrown, Mukesh. So I'll just, probably from my memory, Radhika can correct me. I think the total commissions paid to all distributors was was around 16,000 crores. That's the number, I think, which I remember. And what Mukesh is saying, that if 3 crore people come in on the advisory side and 3,000 rupees, 215 to 12 is charged, it's 10,000 crores industry. So you're almost reaching the distribution or mutual fund size, and that too being on the side of the client. I think it's a wonderful thing. Pratik, you want to add to that?
Yeah, so it's funny that if you look at sort of global business models, especially the ones in the West, people offer free broking or free stock broking. That's a big sort of thing out there, but they charge on wealth management. So they charge fees on wealth management. So the platform or the wealth manager is incentivized to offer more wealth management, less broking. In India, actually, it's what I've seen. It's actually the opposite. You have these platforms that offer mutual funds for free, but then they charge, or the monetization is on broking, which is not really the best way, because you're essentially converting investors into speculators, which in most cases does not really turn out well for the investor. So I believe that's a big sort of rift, and I believe, just to appreciate Mukesh, I think the ET Money is the only platform that's actually doing something which is helping out the investor by building long-term asset allocation and I think advisory. But I feel that so that's a big quotient. The other thing is, and this is obviously from a monetization view, if you look at a customer, how do you sort of delight a customer? How do you make a customer happy? And typically, if you look at, say, most business models in wealth, you want a customer to be sort of stimulated. You want to be able to, you have these metrics called MAUs and DAUs, which is monthly average users, daily average users. But actually, if you look at wealth management, the best thing to do is not do anything. So essentially, that entire sort of, I think stimulation, does not really work in wealth management, because, to be honest, the best advice is actually to do nothing. And if you go to a client and tell the client every 3 months that you're sorted, you're fine, you don't have to do anything, that really sort of may not lead to an excellent relationship, because obviously the client's like, why am I paying you for? So I think how do you reward inaction is something which I think we as industry need to think about, because that ultimately leads to obviously better long-term prospects for the customer. And I think looking at sort of business models, at least on the advisory or on industry where you want to advise people to on the investments, I think this is interesting. So we did a study, internal study, I think last week or a couple of weeks ago, where we actually calculated how much an average investor has made, and this is a real value in the last 10 years. Actually, let's have fun. So suppose the index has done about, say, 13% over the last 10 years. How much do you guys think an average investor has made in the same time frame? Any views out there? Sorry, so this is repeating the question. An average, the index or Nifty 50 or Nifty 500, the Indian market has done about, say, suppose 13% in the last 10 years. How much do you think that an average investor has made in the same time frame? Say last 10 years. 6-7%. Anyone else? 8 to 10%. That's actually right. So I think so. The average. So this is actually in we call it the behavior gap. Which is basically the difference of of what you're investing in versus what you actually achieve. And what we've seen is that there's about 4.7% difference. So if the index has done about 13%, most investors, on average investor, has made about, say, 7.5-8%, which actually, if you think about it, is actually less than a traditional debt fund in the last 10 years' time. So I think the role of advisory is to sort of, bridge this gap. Also, this 4.7 is average investor. So if you remove the SIP investors, if you remove the pension funds, then this can become a lot lower. So I think the whole sort of, I think value add that advisor brings is beyond, which fund to buy, which fund to sell. I think the behavior gap is super important, which is why I think, pricing power is sort of built in, because you're trying to sort of maximize your clients' investments while taking into account and also managing their behavior, which I think is super important, because what we've seen is that the average DIY portfolio is actually quite poor. in terms of their long-term investments, in terms of how they structure their investments, in terms of number of funds they have. So I think advice is really needed in a country like India, where I would say most people are often, or in most cases, quite clueless about how to go about investing and planning for their goals. And lastly, I think on the more ultra HNI sort of HNI segment, this is again what I've seen in business models, is that the benefit or the value add needs to be beyond investments. It has to be beyond investments. It has to be in, whatever it is, estate planning, trust planning, tax planning. So I think that's where you have a huge edge over, in terms of pricing, in terms of making sure that you're adding value to your customer beyond, just their investments, or beyond just offering a simple model portfolio of, 6 to 7 mutual funds. To give you a simple example, when I was involved in a big RI in the US, there was cases where, we would go out there and, the customer's tax liability was, sub 10%, which obviously is all obviously legal and all of that. But, if I'm able to save, hundreds of thousands of dollars in tax for a client, then fees is not really a big issue. So I think beyond wealth is something which, I think we need to imbibe and need to just think about, how can you add value to your client beyond, obviously, the traditional ways of going out there and, pitching products.
Perfect. So we have around 2 minutes, and I'll just take the last question and address it to Shiv. So we've obviously spoken about scale being important for both manufacturing of passive as well as on the retail and online side of things. Let's go into super HNI. It's not as simple, and first of all, there's no scale in it. There are very few HNIs in this country. And secondly, they would obviously require much more, like how Pratik was explaining, they would need tax advice, legal advice, so on and so forth. And then you charge a particular amount of fees. How difficult is that to make this proposition a profitable one?
So I think, you set the context, and Pratik just commented on it. I think Pratik just mentioned it, and you've kind of mentioned it, that when we think about serving our clients, we have to go beyond investments. And by the way, even within investments, we have to cover the entire range of all asset classes, all transaction types. So for example, a firm like us has 6 regulatory licenses, and I'm sure it's the same, for IIFL. And so that's just on investments.
I'm the moderator today. I'm the moderator today. No, I'm
making a comment. We'll come to the questions after this.
Yeah.
But I'm sure you'd have a lot to say on the subject. And then there's estate planning, or wealth structuring, tax planning, real estate services, credit services, and wealth managers dealing with high net worth individuals tend to think of relationship-based pricing and value. So if, on the whole, they can earn enough to justify whatever it takes to set up the infrastructure to provide this, that is okay. Right now, in a highly competitive marketplace like India, even that is challenging. Right? And some of the changes that SEBI's made, which affect elements of the debate we are having here, affect all of this as well. So we've seen structural margin compressions taking place across the whole value chain. So the question of what business model makes sense, where you can be profitable, applies in slightly different ways to all of these business models. And I think, you explained it really well, Mukesh, when you said, you have to think about your competencies, and you have to think about the market opportunity, and how do you relate the two to see whether you want to backward integrate or not, or whether you can just be focused and just go after scale. But that would be our perspective. I think we have to look at the whole, and that's how we indeed look at it. And this passives part of it is just a subset for us.
Fantastic. Thanks, Shiv. And it was, I think, a wonderful mix of views. We discussed all business models on advisory and talked to profitability, the path to profitability for most business models. I would like to thank all my panel members for this fantastic discussion. And if we have time, we can probably open it up for a couple of questions.
Well, we do have room for at least 2 questions. I believe someone's raised their hand there. Let me quickly pass the mic.
Hi, good morning everyone. Pankaj Kaushal this side from Delhi. So right now in the month of March, there was a product NPS which was launched by the two registrars, CAMS as well as Carvi, and there were around 4 or 5 AMCs, including ICICI and others also, which enabled mutual fund distributors to, get a fixed fee charged by the client, and one can introduce this 50,000 rupees under NPS for these introduction to NPS. Can we, to Radhika ma'am as well as to Pratik sir, the manufacturing side, could we have something on the lines of debt ELSS which can be introduced? It can have some sort of a lock-in period, maybe 3 years, 5 years, and it can consist of those debt passive ETF in that, where we can charge an upfront or maybe even a lock-in can be there, so that distributors like me can have some meaningful commissions from them over a fixed 4 or 5 years kind of period. Can we, from the manufacturers, if this can be proposed to SEBI, some kind of product can be launched in those terms?
So I can take that because we've been doing some work as Amphi here. The concept of a debt ELSS, I think, is something that Amphi has been talking to SEBI about and also talking to income tax about, because finally debt ELSS is a provision that needs to be enabled. So that I know has been a conversation since 2019 because we've been trying to push it since Bharat Bond. I am optimistic that that will happen. Whether it will happen in a form that allows, and I think if you were to do a debt ELSS product, the encouraging thing is people are talking now about 5, 7, 10, 15-year kind of fixed income products. Will it be honestly very lucrative from a distribution point of view, even with the upfronting? I don't know, because debt passives and the construct is fundamentally very low cost, and that I think is why it has succeeded to the extent that it is. But the idea is certainly something that we've tabled for 2-3 years and continue to work with the regulators on.